Before we dive into today's discussion about mortgages, real estate, and banking, I want to remind you that information shared in this podcast is for educational, informational purposes only. The content provided is not intended as financial or legal advice. It is always recommended to consult with a professional financial advisor, mortgage broker, or attorney before making any decisions related to real estate or banking. Remember, your financial situation is unique, and what works for one person may not work for another. Now let's explore the world of mortgages, real estate, and banking together. Welcome to Renewed Consideration Podcast. I'm thrilled to have you join us for today's episode, where we will delve into the fundamental aspects of banking and the path to home ownership. I am your host, Lisa Keys, and today I have the privilege of welcoming two esteemed guests. Come on in and meet them. Together, we will be exploring the key factors involved in choosing the right financial institution and understanding the application process with a mortgage lender. So whether you're a first-time home buyer or looking to brush up on your financial knowledge, you're in the right place. Let's dive in. We have with me today, I have Kim Thomas, who is with Apex Mortgage, and also I have Adrian Walthour. So I want each of them to introduce themselves to you today. Adrian?
Sure. My name is Adrian Walthour, and I have about 22 years in the banking, financial, credit union industry. I am I've worked front of the house as a loan officer in branch, back of the house as a loan officer, and several other positions in the back of the house. So currently I am the quality control analyst too, which is a fancy name for a loan auditor. I audit all commercial, consumer, and secondary mortgage loan products.
Thank you. I am so glad to have you here. And Miss Kim Thomas, can you please introduce yourself to us?
Hey, I am Kim Thomas with Apex Mortgage Group. I have been doing mortgages for over 26 years, and I am so good at what I do because I love it. I love my team. I love my company. I love bringing buyers into homeownership. I am currently licensed in several states, so I can help you if you are in Georgia, Ohio, Florida, South Carolina, Texas, Mississippi, Utah, Louisiana. I just love helping people become homeowners.
Great. My name is Lisa Keys, and I am going to be your host for today. I am a licensed real estate broker, and I am the managing owner of Keys and Key Realty here in Columbia, South Carolina. I am also a broker in Georgia, associate broker in Georgia with Location Realty, and I am also a licensed broker in North Carolina, but not. Today we're going to be talking about some information that I think is going to be very helpful for our community. We're going to be talking about banking, the ins and outs of the fundamental of banking and making decisions, and we're going to be talking about the loan process. And I think this information is so important because we have constantly in both arenas, in financing, in banking, and also in the mortgage industry and real estate. We have so many laws that are changing now. So this is our desire to help keep you informed and updated about the processes and also about regulations that have changed or updated that we may not be aware of. So I want to get started with Miss Adrian. And I was sitting here thinking, how do I need to go back and forth, or do I just want to go ahead and go through banking? But we're going to go ahead and start with you, Miss Adrian, and we're going to talk about banking, and we're going to put this very first question up that I want to ask you. Okay.
Okay.
And I want to say I met Miss Adrian, and we started talking, and we said, okay, maybe we should talk about this and let people know, and have a forum where they can, this valuable information can help them make good decisions. So my first question is, when it comes to choosing a financial institution, what are the key factors individuals should consider in ensuring they have the right one for their specific financial needs and their goals?
Okay. Well, it kind of depends on what is it that you need for your bank to do for you.
Okay.
Most of us, of course, we've banked from wherever our parents banked, or whatever bank was in our hometown, or whatever was familiar to us. But we really need to really stop and think and say, what do I really want the bank to do for me? So as far as the banking industry, it's two major institutions that are out there. There's your commercial bank, and I would give you an example of the Red, White, and Blue Bank based out of Carolinas.
Mm-hmm.
The big commercial bank, they are governed by stockholders, and those stockholders come together with their millions and millions, and they form a bank, and they allow customers to come in and bank with them. And as they are making a profit in the banking industry, those profits get kicked back up to their shareholders. And then you have your credit union. So your credit union is more of a cooperative, where people with a common goal, whether they live in the same neighborhood or whether they work for the same company, come together with a small amount of funds, put it in a pot, and allow the members of that cooperative to borrow against that for a return on that small return. And whatever profits are made, because credit unions are not a not-for-profit entity, get shared amongst their shareholders, the members, the people who actually put into the membership fee at that bank.
Okay.
So you really want to figure out what is it that you need to do. Do you need to have a bank where you can also have your commercial business or your small business? Do you need more access to locations and ATMs every other block? What is it that would serve for you? Or do you want more of a white glove touch, that you get more of a family-friendly, community-centered atmosphere, that you get more for a credit union, who may not necessarily have an ATM every couple miles, but maybe one in every area, one in every, branch in every couple of areas. But when you call in there, you're taken care of. They know you. It is more of a white glove treatment.
Okay. Okay. Kim, did you have any questions?
No, I think that was great information. Like myself, I'm kind of with the same bank that I was when I opened my first account when I was 17 years old. So having that information and know that you really should venture out, that is great information, because every day we don't think about that stuff just as a normal banking customer.
Absolutely.
Yeah. So we'll stay with the bank, not understanding if it can meet our needs, because we're constantly growing and evolving. So
Right.
I think it's very good information, so we can make a good decision as to what is going to be the best banking institution for us. So that's great information. Okay. So I got more questions, right?
Absolutely.
So so this is really good. This is one of the questions that I have for myself. So many people are concerned about the safety of their funds. So could you explain what it means for funds to be federally insured and how funds are covered?
Absolutely.
Mm-hmm.
Yes. So when you go into the bank, you are going to see those little stickers all over the place that say they are FDIC insured institution, or if you're in your local credit union, you're going to see NCUA insured institution. So, of course, after the bank collapse of, I think it was the 30s, can't remember the time period, but the government put in place insurance to make sure that everyday Americans don't lose everything if the banking institution fails. So those entities were invented to insure what's in your bank account, and both entities insure up to $250,000. That is the insured amount that the government will allow. What you need to do, though, is, because everybody's banking situation is different, and how it is that you have your money structured in its accounts, you want to make sure that your funds are covered. But pretty much everybody is covered up to $250,000. So then what happens for people who have more than $250,000? Well, you need to go onto their websites for the FDIC, which is going to be your traditional commercial bank coverage. That's the Federal Depository Insurance Corporation. You want to make sure you go onto their website. You want to put in there the types of accounts that you have, the balances that you have, and it will show you on their website exactly whether or not your accounts are covered. The same thing with NCUA, the National Credit Union Association. You plug in what type of accounts you have, how much money you have in each account. It'll let you know whether or not you're covered. Now, there are ways to get those coverages to kind of compound on each other when it comes to your different types of investment accounts, such as IRAs or CDs. Sometimes you're not just covered up to $250,000; you may be covered up to $250,000 per owner. So, therefore, you can maximize insurance coverage should there actually have another bank collapse.
So another question I had is, what about the Cash Apps, the Vimos, the Zelles? What about those, and are they insured?
So, those institutions are not federally insured.
Okay.
Those are person to person or bank to bank transfer institutions. They are just supposed to take bank funds from one of your accounts, your banking accounts, transferring it to a person. So it could go on a card, it could go directly to your other bank account, but it's an intermediary. It is not insured at all. Therefore, should you lose funds once it leaves your bank,
Mhm.
you're not covered. Again, it would be like taking money out of the ATM, driving down the street to give cash to somebody, and you're accosted and your money's taken from you. You're kind of out of luck. There's nothing you can do about it. The cash is gone. It's not insured. So the same thing with those institutions. They're great products to have, short term, small amounts of funds, but those are not your banking institutions. I would not make those your primary banking institution.
Okay, because they have what Chime. What do you know anything about that? Is that insured?
It
How
is
does it?
not insured.
Okay.
I do believe that Chime is more of a uh, I know they have P2P services, but I want to say that most of their that entity itself is more of a debit card type, reloadable debit card type situation with
Okay.
Chime itself, but it is still considered a non-insured entity as well. It's just a way to transfer it from an insured bank account,
Mhm.
or of course you can load a card or something like that with cash, but it is a way to transfer from insured bank accounts to a third intermediary party, whether you're
Mhm.
giving it as a gift or you're transferring money, like I said, on a short-term basis. Would not advise you to use that as your primary financial institution.
So you said P2P, but I was assuming that's person to person.
Person to person, or some people use B2B, which is bank to bank or business to business. It's just a transfer portal. That's all that is.
Okay. So, can you tell us what FDIC stands for? Can you?
Sure. The FDIC stands for the Federal Depository Insurance Corporation.
Okay.
And they are the insuring entity that covers the funds that are in your checking, savings, secondary savings, your minors accounts, everybody's account. Your basic checking, savings accounts are covered if they're in a FDIC insured financial institution.
Okay.
And
So,
NCUA for credit unions. I don't want to leave them out at all.
okay. Okay. So, in essence, so if you take once you send the money to an individual, once it leaves your account, someone can intercept it and take it, and there's no way you can get it back. For
Correct.
individuals in the Zales and the and the Cash Apps, right?
Yeah.
Oh,
Yeah, that's true. Once it leaves its federal protection umbrella, you take a risk. They are convenient. There's
okay.
a niche market for them. But if somebody, for example, if you go to send money out, and
Mm-hmm.
I think they have enhanced a lot of them with a secondary security feature, but let's just say somebody knows your Cash App PIN.
Mm-hmm.
That money's gone. I mean, again, it's like cash once it leaves your insured institution.
Now, Adrian, you did say that you did audits, right?
Yes.
Okay, so can you tell me a little bit more about the audits that you do?
Sure. So when you go to your local institution and you get, whether it's a small loan, a car loan, a commercial loan, or what we call a secondary mortgage loan, my job is not to check the loan while you're doing it. At this point, when I get the loan, you have already had the keys to your home, you're
Okay.
already in your car, you already got the money and probably spent it.
Okay.
My job is to make sure that all the information on your application, all your paperwork is correct, complete, up to process and our process and procedure, and that there has been no missteps. There has not been any violation of any federal regulations when it comes to the lending process. What I do, of course, has no direct bearing on the consumer, but it does basically check your fellow employees and make sure that everybody is doing what they're supposed to do, so that the institution can, have sound, whole loans as much as we can possibly see on the front end. Of course, life happens to people, but on the
Yeah.
front end, we want to make sure we're doing everything that we're supposed to be doing and have all of our I's dotted and T's crossed.
Okay. So you're the person that I hear them talk about the closing table there. Okay, that's good. That's good. That's good to put a face to the process. So that's
Yeah.
good. Okay. So if you could put up the next question. Okay. Um, so this particular question right here is something that I think is very important for us to understand as a community and consumers. So if there's an event where there's unforeseen circumstances such as you're incapacitated or you're passing away, how can we ensure that our loved ones have access to our funds?
Absolutely. So when you sign up for your accounts and you go into your institution, or you go online and you sign up for your accounts, there are
Mm-hmm.
spaces for you to put additional people on the accounts. Now, joint owner is a little tricky for people because that gives people access to your funds immediately, whether you're incapacitated or not. But
Okay.
there is also something called a POD, or payable upon death, which
Okay.
means that banking institution will call and make sure they make arrangements to make sure you get your funds, should you pass away.
Okay.
There are several documents you can use for incapacitation, such as a POA, all sorts of successors. You can be a payee, should it be government funds involved. There's a variety of different titles you can have for those situations. What you do want to make sure is that something doesn't happen to you, and now you have to start what I call the paperwork party, which is trying to run down a lawyer and figure out stuff, get doctors' signatures, et cetera, et cetera. You want to make sure you are set up from the beginning. So if nothing else, I would definitely make sure that we have PODs on account so that the institution knows who to contact should something happen. It also would be a good idea to actually maybe look at some legal advice as far as how you want to set up your accounts, should something happen to you. So whether or not you have let's say you have an IRA or an estate account, and you already have your estate listed, it's already in with your bank, your accounts are set up properly. You want to make sure that your successors are listed on your estate. If something happens to you, your estate continues through your successors. Um, Again, a lot of these documents, you are going to need some type of legal advice, attorneys. You want to make sure you're following that proper step.
Mm-hmm.
But there are other things that you can do to make sure that your accounts are safe, that if you are incapacitated, your bills continue to get paid. People have access to your funds if you need them for medical reasons or for final expenses, etc.
Okay, that's good. So in every aspect, or when you put in a person on your account, they don't have access to it, but they can be the person who that is notified or who has access to your funds in the event of untimely circumstances happening. Right.
Correct.
Okay.
What I can tell you, and I don't know about every state, but I can tell you about Georgia.
Okay.
In the state of Georgia, there is a code on the Georgia state, how the codes are written for the banking codes,
Okay.
that says that if something happens to you and you have less than $15,000 in your account and you are one of the designated next of kin, so in the
Mm-hmm.
state of Georgia, we recognize spouse first,
Okay.
children second, parents third, siblings fourth, and in that order. If you're not in that list, it's
Okay.
not going to work. But you
Okay.
can get up to $15,000.
Okay.
And you can also use those funds for burial. Now, there are some procedures for each financial institution. They may request a letter from the funeral home that's handling your final remains or any of that. And you can get access to those funds fairly quickly, even before the insurance can pay out. But each state is different. So I want to be sure that I say that. Each state is different. You have to make sure that you know the legal procedures for your state. I have dealt with several. All of them are a little different. None of
Okay.
them are like Louisiana. That is a totally different set of animals. So if it's Louisiana, definitely get you an attorney because theirs are really, really different. But you
Okay.
want to make sure that you can be able to access funds because when you're in that type of emotional state, not
Mhm.
having these things together can really, really cause a lot of stress on families. So you want to make sure you have those things in order when you're setting up these accounts. These are things you need to be thinking about.
And that is great information. I'm trying to tell you because we need to be more mindful of that. And that, I mean, just understanding, to go in there and be able to say, well, does this apply in my state is, good information for us to have as well. Can I, how does that work in the event of, how to go in and ask the right questions, so you can make a good informed decision. It to me is all about having information so you can make a good decision. So I really do appreciate you sharing that with us because I think it's invaluable information.
In case of my incapacitation, go here. Something to that effect, where you have all of your bank accounts listed, because that's another thing. Some people
Mhm.
hide bank accounts from
Oh,
themselves and their
oh,
family members.
okay, okay,
And so you've only seen them go to Community Bank A, but most of their money really is in Community Bank B. We're not going to talk about that one. That's going to hide in that one. But
okay,
you want to make sure that you have that information written down, including any clubs that you may be a member of that are also going to be able to give you like a payable upon death type benefit.
okay.
Um, Insurances, of course, you want to make sure you have, your housing paperwork together, your car paperwork together, retirement, all those things. You want to make sure you have at least a folder to keep that stuff together. It makes it so much easier on your loved ones when they're going through one of the most traumatic periods of their lives.
Man, that is great information. I was going to add that, but you did it for me, so I don't have to now. So great minds, like having all that information in one place and preparation is key. So,
Yeah,
I mean, that's great information. Thank you so much.
you're
Thank you.
welcome.
Thank
You're welcome. You're never too young
And
either.
I just wanted to state that me and Miss Kim have a heart to serve the people in our community, and I just appreciate her taking her time to come on here. And you see, her name is the Mortgage Whisperer. To come on here and to help us understand the process of your mortgage loan and applying for your loan. So, if you don't mind, please put up that first question from Ms. Kim. Okay. So, can you provide insight into the role of pre-approval in the home buying process and how it benefits the prospective buyer? And is there a difference between the pre-approval and the pre-qualification process?
Absolutely. All right. So, as a borrower, one of the very first things that you want to do is make sure that you can qualify for your house so that your real estate agent will want to take you out to look at these properties.
Yes.
So, you and two, just because of where the market is, houses come on the market and they're gone so quickly. You do not want to go out, fall in love with a house, and then it's gone because you didn't get your pre-qualification or your pre-approval first. Those
Mhm.
two words vary differently depending on the type of company that you're working with. So some places the pre-qualification means, hey, I plugged my information in and it spit out this letter that said I qualify. That letter gets spit out based on whatever the borrower plugged in as their information. Nothing was reviewed, it just read what they put in. That system is only as smart as the information that got input into it. So it
Okay.
could be information that wasn't verified. For
Okay.
me on my side, if I'm issuing a pre-qualification letter, I'm reviewing and I'm interviewing the borrower to make sure that all of those pieces work together so that I can get you a letter so that you can go out to your agent and know that if you present this, you're closing on your home. The pre-approval process also kind of varies a little. Some
Okay.
companies use the word pre-approval, meaning they've reviewed the documentation. As a loan
Hmm.
officer, they've reviewed the documentation. Some places say pre-approval because it means that the documentation went into an underwriter and it was reviewed by an underwriter. So when you're talking to your mortgage professional, just verify what's going on with your situation. Is the loan officer reviewing it? Make sure that it's not an AI system that's just reading information that they plugged in. That is not a true qualification. And that's where, you know, a lot of borrowers go out, fall in love with a house because that system generated it. And then they go to submit their documentation, find out they don't qualify because nobody looked at their pay stubs or W-2s or their tax returns. So they don't truly qualify.
I just talked to my lender. They said I'm pre-approved and I can go buy a house. So he and his wife, we went out. They were veterans, and we looked for a house, found a house. They liked it, and then that same lender that gave them that pre-approval denied them the loan. And so at that point, you know, people get discouraged and they don't want to move forward in the process because they don't want to feel that disappointment. And so for me, I knew I had to go through the journey with them. I had to say, you know, he at this point he wanted to give up. He said, "I just want to get a house for my family," and because I had to identify the way that I was feeling about the whole scenario, everything that happened, and I was like, you know, I have enough faith for both of us, for all of us. We're gonna make sure you get the house. It doesn't matter how long it takes; it's gonna happen. And so that led me to have to go and get some additional understanding about the process of being a lender and working with lenders and understanding credit. And it helped me to take care of all my clients because now I had this information and I knew process and I knew what the expectation was. So I appreciate you sharing that information with us, Kim. I really do. So now I have another question for you. Okay. It's the next question. Okay. And so the process of down payment and how it affects your mortgage process. I mean, what options exist for individuals who may have difficulty with making large down payments?
Okay. So I have a lot of information for this one.
Okay.
All right. So the first misconception that we have from most borrowers is, for some reason, there are a lot of borrowers that think they need 20% as a down payment before they can buy a house. So they just keep waiting, trying to save up this 20%. It's not true. You don't need 20% in order to start the process for you to buy a house. If you are a first-time home buyer, depending on the kind of loan that you do, there's going to be different down payment requirements. So conventional is one type of loan. If you're a first-time home buyer, that could be as low as a 3% down payment. FHA could be 3.5%. Then you also have a couple of programs that is no down payment. So if you are a veteran, that is no down payment. That's 100% financing. You also have another loan type. It's called USDA, and that's going to be for your more rural areas. And of course, you have to check the property. It's going to have income restrictions on it. You can't make too much money, and the property has to be within a certain area. That one also is zero money down. It's 100% financing. You also have down payment assistance programs. Okay. Down payment assistance programs are not the perfect fit for every family. A lot of times, the down payment money is not free money. It could be that there could be a small monthly payment. It could be a second mortgage. So you have a small monthly payment to pay back this down payment assistance. It could be that that money is going to remain due for the entire life of the loan. So if you ever sell or refinance your house, you have to pay that money back. It could be that the rate is going to be higher, which means that your debt ratio is going to be higher, which means your payment's going to be higher, which means you might not be able to qualify. There are also some programs where it's a double underwrite, meaning that not only do I have to get you approved with my underwriter, get your conditions, get all of your conditions signed off on, get your clear to close, then I got to send you out to this down payment assistance company. They got to underwrite your file, and they got to ask for conditions, and they're going to get you clear to close, which that is going to delay your closing. That's going to lengthen the amount of time that it takes you to get to closing. So identifying other alternatives to using down payment assistance, you know, is key when talking to borrowers. Every family's different. Every family is unique. So being able to take the time to meet the objective and to take care of them long term, that's what we're about.
And could you address gifts as well?
Absolutely. So a couple of the things that you can use. So instead of looking to do down payment assistance, as may not be beneficial, there are
Mm-hmm.
other options that you can use to get that money. Tax
Okay.
refund. So we have tax season coming up. So right now is a perfect time to save that tax refund money. Don't go spend it. Don't go shopping. Save that money to buy your house. Especially if you're self-employed, right now is a great time to get with your mortgage professional before you file those taxes to get this refund and identify, the objective of being able to buy a house and what those tax returns need to look like. Gift money. So, family, somebody has money they want to be able to gift you to help you towards the purchase of a home. That's an option. Liquidating funds from your 401k. That is an option as well. A lot of times there's less of a tax hit on you when you're using those funds to purchase a home versus just doing a loan from your 401k. So there are a lot of other options that you can explore that may benefit you long term versus just going straight for a down payment assistance program.
And I'm sorry, Adrian, I do apologize. Do you have any questions? I do.
Well, no, I was just gonna ask her if she could just restate the percentages of down payment and the types of loans one more time.
Absolutely. So your main categories for loans that you're going to hear about, most off, you have conventional, you have FHA, you have VA, and you have USDA. The two that have no down payment is your VA and your USDA. Those two offer 100% financing. You've got to be a veteran for a VA. You got to be in a rural area for USDA. Conventional is going to allow you to have a 3% down payment. FHA is 3.5%.
Okay. And so is there, of course, I know there's a criteria for you to be able to be approved for that 3% conventional, which is one of my favorites, I must say. 3%. The conventional, I always, like that one. But is there a criteria as far as, a lot of people come into that I talk to come in, well, my credit score is good, but there's so much more that we're looking at. And one of the other things I wanted to ask you, Kim, is about I know the requirements for student loans have changed. I know it was once 1%, and now is it 0.5% down, and that's going to be included in your debt to income ratio?
It is. So again, it's going to vary on those different products.
Okay.
So conventional is going to be a little more strict on you as far as your debt ratio requirement.
Okay.
Debt ratio means that's the comparison of your income and your debt expressed in a
Mm-hmm.
percentage, meaning
Mm-hmm.
how much of your income is it taking to pay all of your bills plus your
Mm-hmm.
mortgage payment. Conventional can go up to 50%
Mm-hmm.
sometimes. It's not always going to approve you there. So
Mm-hmm.
essentially sometimes you can have a 50% debt ratio, meaning it's taking 50% of my income to pay all my bills plus my mortgage.
Mm-hmm.
FHA says, hey, well, you know what? We might let you have 56%. Okay.
Okay.
That can be a big difference in qualifying.
Okay.
Conventional, conventional is going to be a little tougher on your credit score. It's going to want your credit score to be higher.
Mm-hmm.
FHA, it's not so tough on you. You can have a lower credit score
Okay.
and do an FHA loan. And then I forgot, what was the other part of your question?
I wanted to ask you about the student loan
Student loans.
aspect when it
Okay.
comes to debt to income ratio. Yeah.
So student loans again are going to vary depending on that type of product. So
Okay.
in conventional, you have say two types of conventional loans. You have Fannie Mae and you have Freddie Mac. Fannie Mae is going to say, okay, well, we're going to use 1% of the balance of that student loan if the student loan's deferred. Okay.
Okay.
If there's already a payment, if you're already in repayment, of course it's going to use whatever that payment is. Same thing for
Mm-hmm.
Freddie Mac, which is also conventional. Now, Freddie Mac says, hey, well, you know what? We'll use 0.5% of that
Okay.
balance as your payment versus
Okay.
Fannie says 1%. Now,
Mm-hmm.
both of them, if you are in an income-based payment plan, and if
Mm-hmm.
that payment is zero, they will let you use that payment of zero to qualify. Now, the difference between those and say FHA says 0.5%.
Mm-hmm.
And FHA says, well, you can be in an income-based payment plan, but that payment has to be at least greater than zero for me to use that payment plan payment amount. So a little bit different in each one of those categories.
So I want to ask a question because this is
Mhm.
something that happened. So So if the person has an amortized student loan, but it has an end date, and they have a set amount, that dollar amount, say the dollar amount is $56, would you be able to use that as their payment versus the 0.5% or the 1%?
So are you saying, is that a payment plan, payment amount you're talking about? So they're in an income driven payment plan.
Well, not, I don't know if it's an income driven, but I have seen some, and I don't, because me and you we haven't talked about this, but I have seen some lenders that will, as long as you give them a letter that has an amortized date on it, an end date, and they can see your payments are going to be consistent, that they will use that amount on that letter for your, as a part of your debt to income ratio.
Right. So as long as you have documentation that's confirming that payment plan and that payment amount, then yes, you can use that payment amount.
So how does the interest rate impact the overall cost of the mortgage? And what advice do you have for borrowers seeking the most, the most advantageous interest
So,
rate?
first of all, don't let interest rates discourage you from purchasing a home. The difference in those interest rates is not so dramatic, except when you have those 2%. 2% compared to where we are right now is a dramatic difference.
Mhm.
But that's not going to come around again. That was a one-time something that had happened. So interest rates right now, they're not abnormally high. We were honestly, before COVID, the rates were kind of trickling up just a little bit, and then COVID hit, and then you kind of got this freeze on the movement, and then the rates all of a sudden, boom, now they're up this high. COVID slowed down that slow progression that we would have been in to see rates kind of where they are right now. And so we just all of a sudden got shocked with, now here's where the rates are. So I believe that if COVID had not hit, we would have probably been pretty close to where we are right now, where the interest rates are. They are not abnormally high to where it should be discouraging to buy a home. Also, you have more control in your livelihood and in a roof over your head by being a homeowner versus being a renter. There's not a big difference in that payment between 6.5% interest rate, a 6.25% interest rate. Those payments are not dramatically different. Now, the thing that affects, because the other part of your question was, how do the interest rates affect your overall cost of the mortgage? Interest rates, for the most part, interest rates cost money, which means it's an extra fee that you're paying at closing. It's going to be part of your closing cost. You're going to be bringing extra money to closing for your interest rate if your credit score is really low. So the better your credit score is, the better your interest rate is going to be, and the better the potential cost of that interest rate is going to be. So getting your credit where it needs to be to help lower those costs of the interest rate, also plays into it. Again, that's something you want to make sure you're talking to a mortgage professional about to see, how does this actual situation help you? Do you need to work on the credit? Does the working on your credit even move you enough to make an impact in that interest rate and or the cost of the rate? Did that answer your question?
Yes, of course. Yes,
Okay.
more than answer my question. More than that.
Okay.
That I think is so important, because so many people like, well, the interest rate is too high. I understand the people who have the 2%, because I know a few people who have the 2%, and I wouldn't give up 2% either. But so I understand that. I do understand that, and I there's so many changes going on right now in real estate, and so I thought this was so important for us to come on and have a conversation about it. Now, I want to do something before we end. I want to allow each of you to ask me a question if you guys have a question. Okay.
Okay. So, when you are meeting clients and they are telling you that they want this mega million mansion, and they are qualified for, 100,000. Explain to me, as a realtor, how do you bring those expectations of their dreams into a reality of what their budget is? How do you have their budget meet their dream, I guess is what I'm like.
So this is really important, where the partnership of being a more working with a mortgage lender comes in, because for me, my process is to make sure that I ask my client, how much do you want to pay for your mortgage each month? That's what I ask. Okay. And then I ask them, what is your budget? And then I determine how far apart they are. So that helps them to understand. And it's not just that I ask them, I show them. And so I'll say, okay, so let's get on the phone with your mortgage lender and let's ask her, if you want if you want to pay this amount of mortgage per month, let's find out what your lender is saying, how much house you can afford. And so that helps them to understand, not just from my aspect, but from their mortgage lender's aspect. And they have two people verifying what is going to be the best course for them. And when you do that, it helps them to be more secure in the process of purchasing a home. And then they feel more, they feel like they're more empowered because they have the information they need to make the best decisions. So that is one of the ways that I have to sit down, because a lot of people want to see the numbers, and I have to help them be realistic. And I'm very honest with them, because I don't want them to waste their time and feel disappointed. And then I don't want my time wasted either. So if I'm not upfront and honest, and I'm not educating the people who I'm working with, then I'm doing a disservice to them, because I don't want them to have a bad experience. And I have to tell them, okay, so this is realistic, or maybe this is not realistic for you. Did that
Okay.
answer your
All
question?
right, so Lisa, I have a question for you. So we talked earlier about down payment assistance and
Hmm.
different ways that borrowers can get funds to help with closing costs.
Hmm.
Another key way that helps borrowers save on their cost is getting contributions from the seller. So
Okay.
how do you approach those conversations with your clients and or in your negotiations, potentially in identifying if this property could have seller contributions?
And that is, very important during the negotiation process. And so I have to do a lot of research when it comes to me working for a buyer and looking at what the seller is offering. And a lot of times, the seller is offering, especially, this it's a house my client loves it, and they really, want to get this house. I will reach out to the other agent, and then I will speak to them, and I will, I have a client who's really interested in the property, and I will explain to them, the situation, and then ask them, be honest. What is your client willing to do? Do they want to sell? Is this acceptable for them? And then when we were in the market where we had like 20 and 30 offers on one house, that was bananas. So
Mhm.
at that point, the only thing they want to hear is the highest and best offers. There is no room for you to negotiate or say nothing else, because at that point, the sellers were in control. But when you have a kind of balanced market where you can go in and you can talk to the sellers and let them know that someone is interested in your home that you have on the market, and talk to them about terms. Um, this is what I'm talking about when it pertains to resales. Okay. So resales are homes that have already been purchased and that are being resold by the current owner of that home. And
Mhm.
so you have to go in and have conversations with them, and just to and let them know, this is my client is really interested. How much can you help with? Can you help with any closing costs? So we go in and we have those conversations to see if we can come close to what both parties are needing. So we are satisfying the needs for both parties. Most times we have a good situation where we can get them into that home. Now, when it comes to new construction, and I had this incident recently where there's always a preferred lender, and sometimes that particular builder may be in partnership with that mortgage company. So they always offer incentives for that, and they may not necessarily always be the most beneficial for you, but they can be beneficial for you. So if they're offering you, they're offering the purchaser, the buyer, and also the agent. They're like, well, we have 5% commission for you. You bring us a homeowner, and then we'll pay them. Right now, this is happening right now. We will pay $10,000, $15,000. They want to buy down their rate if they want to, you know, towards incentives and upgrades for the property. So they're offering all these different things right now, because right now the new construction builders are because the inventory is so low, that's where everyone is going to. They're either getting it built, or I had a client yesterday, had to go walk the lot with her because she's getting the house built on it. So in those particular situations, it varies because there's a caveat of things that each person is going to need. You have to tell them, and they have to decide what is the most beneficial thing for me when it comes to me purchasing a home, whether it be resale, new construction, or buying acreage, or buying a lot. Is there anything else you want to ask? Because I have a question. I put a question up as well. If you don't mind, please put up that question for us. So this is a particular. It's a question. Me and Adrian were talking about this, but it's a process that I put in place for my homeowner. So the question is: you mentioned the process you developed to assist clients with financial concerns, and could you elaborate on that process and how it helps our clients in their journey towards home ownership? And so one of the things that I've done, it was I called it healthy finances, happy family, and it was just like a financial awareness 101. So for me, anytime I sent my clients to go ahead and get their start their application for their loan approval, I wanted them to feel comfortable that they were going to get approved. Okay. So, of course, this journey started in 2017 when my client got denied by the lender who had given him a pre-approval. And so this was my process of understanding and helping my clients, because a lot of people come to me and it's like, well, I want to purchase a house, but I don't know where to get started. And so for me, I had to come up with and have answers for them. And I never wanted to send them to my lender and they not be ready. I think I send um Kim someone, and she won't be ready for a couple years. And I was like, okay. So that let me know that I have to sit down with them, have a conversation with them, and talk to them about their resources and how they're using them if they're willing to. This is a separate part of the business that I do. Okay. And so what I did was I made sure that I sat down, I did some credit consulting with them and counseling with them. And I even go to the extreme where I will sit down. I'll be like, okay, because one person told me they made about $10,000 a year. It was, I mean, not a year, a month for this couple. But then they don't have anything in savings. So I said, okay, so let's sit down. So we wrote out a worksheet. They put down all the information, and we looked at a bank statement, the most current bank statement, and we went through it line by line. And then they saw how they were spending their money. So they were like, well, you was at Best Buy, well, you got your hair done. And so they were they were having a conversation, because before they weren't having a conversation about it. Mm-hmm. And so for me, it was good that they were just having a conversation. Mm-hmm. Yeah. So I was showing them how they could cut cost on their monthly expenses, because they weren't paying attention to them. And so I'm like, if you tell me these are all your credit card, this is all your vehicle, your automobile car note expenses, this is all of your expenses, then where's your money? And so then there's usually silence. Okay. So then I said, if you stick to this plan, I said, I will give you the date that you can go ahead and start applying for your loan. You have to promise to be dedicated to this. So you put X amount of money in your savings, you put, and you stop spending here. All that money that you are saving now, it goes into your savings account, because this is in preparation for you to purchase your home. And so I had it was time consuming, but for me, when I can go through the process, and I can tell you, I went through this process with about 10 people, and I went through it and I helped them with the process. But I can tell you right now, they were so appreciative, because in this process, and they paid down things. I was able to tell them how much they need to have usage on their credit cards, and I was able to give them the information they need in order for them to make the decisions for them to become homeowners. And I think that's just what people want to know. They want to know how much you you care. They don't care how much you know. That's what my coach would tell me. That one of his coaches said to him, people care. People don't want to know how much. They don't care how much you know. They want to know how much you care. And
Mhm.
so people know that you care and you're there to help them, and you're not trying to take advantage of them. They're more open to working with you. And then not only that, I have the daughters, and then they refer so many people to me because it's such a joy to me to help. And so for me, that's why I enjoy doing real estate so much. Because if I can take you from a place that I'm never going to be able to purchase a home to putting keys in your home in your hand, that
Mhm.
is such a joy for me. I mean, I really do love it and I appreciate it. And now I don't do that as much as I used to, but I do consult and I do talk to my clients and I prepare them. And it's because I do that work with them beforehand, when I hand them off to their lender, they're already ready to go. And my lender, this is before I started working with Kim. My lender loved me to send people to him.
Mhm.
They were ready to go. But it takes dedication and really caring about people, in order for you to take your time and to do that. And for me, I enjoy helping people accomplish that goal. And I believe that I will be blessed because I cared about, helping them. And I think that's what we're all supposed to do. We're supposed to help each other reach a goal. If we have the ability and the know-how, that should be our purpose, not to take from anyone, not to use them as a resource to take advantage, but to help them. So, is there anything you want to ask me, Victor?
Well, I will share that for me, when I worked front of the house, I had a
Mhm,
lot of young men who were just starting out in the work field. So we're talking about fresh out of high school and in a rural town where on working on the port, I'll say it that way,
mhm,
was one of the main drivers of income in that area. And I have had to close my door and get monopoly money out and do the exchange of monopoly money, just trying to show them how to use a credit card, or that, walking around with your entire paycheck of cash in your pocket's not safe. How to use the checking account and the savings account, and which account you can actually do ATM and debit card withdrawals out without having any limits, and which account is the actual savings account, and then working them, understanding that knowledge and how critical it is to just pay that credit card, even if it's secured. They'll have the cash. The money's not the problem, but
mhm,
not understanding how bills are paid, how you
mhm.
reduce the amount of interest you pay on a card,
Yes.
all of that. That just is the pre-K to what I consider to be the home ownership, to be the graduation. Just getting you into that, how money works for you and how you work the money so they can work for you in the long term. I've done that with lots of young people throughout my career, especially working it as a loan officer in the front of the house. And then, of course, being in compliance before I became an auditor, working with people, dealing with deceased accounts. My poor little widows, especially those from the 40s and the 50s when they came up in that
Mhm,
era, back
mhm,
when you were Mr. and Mrs., not understanding how important it is to have your actual legal first name on accounts,
mhm,
how to understand what bills are actually being paid, because of a lot of women from that age, that era, didn't pay their bills. They had no idea, they just knew they were paid.
mhm,
Getting them to understand what bills that they have, how they continue to be paid, getting them around the matrix of what's going on the account because they didn't have anything much to do with it, and being patient enough and empathetic enough to understand they're going through the worst time of their life. They just lost their life partner that they've been with for 40 and 50 years. And understanding that I'm there to help them, assist them in this new phase of life. And even sometimes that I'd have to stop the conversation just to say, well, tell me how you met your spouse, just to bring down emotions so I can get back to the business that we're there for. So that is where my calling and my heart was for so long. I really truly missed that work. Of course I have moved on to something else, but I truly have a heart for helping people that are in positions where they really just don't know, just getting them off the ground to get to on that road to home ownership is really important to me.
I appreciate people who don't limit their professional compassion to personal. Even sometimes strangers, as you mentioned. So I just think that's so admirable, and I think that it should not be at uncommon. I think it should be a normal practice for us. I think that's what we should be doing. And Kim, I want you to give us some insight. And I know you said that you love what you do. I know you said that you are good at what you do. And I
I
think that
humbly am. Yes, yes, because I love it.
I love that.
I think we all feel that exact same way. I think that we all feel like that we are good at what we do and that we care about people more so. And it's
True.
not, I want to say this, it's not just that we are good alone, but we have Christ in us that guides us, that helps us,
Yes,
because that's why we have the compassion that we have for people. And
Absolutely.
so, and I think that's phenomenal. And I'm so thankful to be here with these you two young ladies who have a passion for helping people, and that's why we're here.
yes,
Okay, so then after Kim, we're going to go ahead and we're going to give last. Well, we don't need to do any last remarks, but we're going to go ahead and close out, and then hopefully we will do this again, ladies. Again, I really enjoyed this. Okay,
yes.
so
This is great.
Kim, if you don't mind.
Okay, so again, I do with both of what you ladies are saying. That's why we're so on point together. I love helping people. I feel like everybody should be a homeowner. I want to help everybody be a homeowner.
Mhm.
One of the things that I find about myself is that God blesses me with the credit challenged. And that's because I have the patience, I have the heart to serve. I want to show you how can you get to that point. A lot of people just kind of throw you to the side when your credit score is not where it needs to be. They can't hurry up and do a loan for you. They can't make a paycheck off of you fast enough. So I've had a lot of clients say, yeah, well, they just told me to go work on my credit. And I'm like, well, they didn't tell you what to work on. And they're like, no, they just say go work on your credit and come back in 6 months. Well, I'm going to look at your credit with you. I'm going to give you direction. I'm going to give you guidance. I'm going to give you that this is why, and this is how you fix it, and this is where you need to be. A lot of people don't get that. They don't get that conversation. When somebody knows what they work on, when they can see what that dream actually looks like, that it's not a dream, it really can be reality, and this is what it looks like. Now they're
Mhm.
going to be excited to go do those steps that it takes to get them where it needs to be. It's not as hard as it once was because you don't know what you're doing. You feel like you're out there doing it by
Yeah.
yourself.
Mhm.
Everywhere I go, I'm asking somebody, hey, do you want to be a homeowner? To the point that I made a lady cry in a restaurant one time. She was my waitress, and she started crying because she did want to be a homeowner, but her credit was terrible. And I got this whole story of why her credit was so bad.
Mhm.
And it's just, you
Yeah.
can't be embarrassed because life
That's
happens to
Hmm.
that.
all of us.
It
Yes.
does.
So talk to somebody that you can trust that can help guide you where you need to be. But
Mhm.
the first step is reach out to somebody. Listen to those conversations, listen to those trusted people because you have to have kind of that ear to know that you can trust this person that you're talking to. Somebody shouldn't be talking in circles around you. You should be able to understand what they're talking about, and all of those pieces should fit together. If they don't, then you're talking to the wrong person.
That's right. And I agree with you. One of the things that I tell people who are embarrassed to talk about their credit is life happens. You are not the only one who life has
Mm-hmm.
happened. And it's okay. So if we don't talk about it, it's going to stay the same. But if we talk about it, we can fix it. And
Hmm.
so,
Yes.
yeah. So I agree with you 100%. So we're going to end now, and I thank you guys so much for taking your time to come and participate with me and to share this information so that people can have a process to move forward and make some decisions for home ownership, banking, in the loan process, understanding the loan process and how we can go ahead and get started. Thank you so much. I appreciate it. And until next time,
Thank you.
Thank you.
thank you for joining us on today's episode of Renewed Consideration. We hope you gained valuable insight into banking fundamentals and the path to home ownership. To stay engaged with us, make sure to subscribe to Renewed Consideration on our YouTube channel. Join our active community in our private Facebook group where we discuss a wide range of topics from understanding biblical principles to all things real estate and business strategies. Keep informed, stay connected, and continue to renew your consideration in the world around you. Until next time.